Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Colgate Palmolive Company, ticker CL. Over the next few minutes, I'll give my thoughts on both valuation of this company and its business quality. Now let's dive on in. First up is market cap of $68 billion, enterprise value of $78 billion. We can see about $7 billion of leverage on this business, so you should expect that to give a higher return on equity than your return on invested capital because of that. They operate in the household products industry, which means its brands are going to be very important. Let's see if we can read off some of these brands. So they operate in two segments: oral personal home care and pet nutrition. So those brands include Colgate, Darlie, Elmex, Hello, Meridol, Sorsos, Tom's of Maine, Irish Spring, Palmolive, Protex, Sanex, Soft Soap, Lady Speed Stick, Fabuloso, Murphy, Soupline, and Cuddly. Pet nutrition includes brands under the Hills Science Diet and the Hills Prescription Diet brand. So give you some idea of what they're operating. These tend to be relatively good businesses. Anytime you can have branded products, you tend to be able to get good margins compared to your input costs, so it tends to signal quality. Another sign that signals quality is this low beta, 0.50, suggests that, again, 1 would mean it has the same volatility as the average company in the S&P 500, and 0.5 mean it has half the volatility of that company. Now, the volatility of a stock doesn't mean the volatility of the business is similar, but it often signals something like that. Now, the next sign that we see of a quality company is this return on invested capital chart. You see 20 straight years of positive returns on capital. That means there are no losses in the last 20 years. That's a very positive sign for a high-quality business. In addition, the lowest return on capital came in 2015 with 19% returns on capital. That's a very, very high mark to hit. All of this is extremely good, phenomenal. My goal is to get this number above 10%. 15% is amazing. This 20 to 40% range is outstanding. So very, very good numbers here on return on invested capital. When you look at 10-year median returns, we see return on equity of 207%, return on invested capital of 28%. That is that leverage effect of this $7 billion in debt that I mentioned. They're really leveraging it up. In addition, what this really means is they're really not operating with equity in this business. This business is operating almost entirely probably with debt. Because they're able to operate almost without equity to have such a high return on invested capital. Any money they're creating, they're probably being able to pay out in dividends, pay out in buybacks. That's probably what this is telling you here. It also tells you the same because you're seeing this price to book ratio of 122. That number is inflated probably due to buybacks taking place above book value. Eventually that would drive your book value negative. Sign of a very strong capital allocation, very strong returns on capital, all suggesting this is a very high quality company. Now, though, the problem that I see here is valuation. You have a PE ratio of 35. A 35 PE ratio is just really, really high. It's especially high with a basically flat revenue growth. You can see you started the decade at $17 billion in revenue. You end the decade with $17 billion in revenue. Almost zero growth across the decade. You have some years go up, some years go down. They've recovered a bit. But overall, this company is not growing. EPS is functionally flat. You begin the decade at 257, you end the decade at 255. So no growth in this business. That's actually very, very bad. What is a no growth company worth? Regardless of the return on invested capital, no growth companies are worth like a PE of 8. So what's a PE of 8 for 250 here? So times 4 is 10, times 8 is 20, a price of 20, yet the stock price is 82. That means that the fair value of this stock company might be something like a price of $20 per share. So amazing returns on capital, but you're not getting those returns anymore because return on capital is only relevant if you grow. If you don't grow, then it's functionally the same. You're paying out all the money in cash anyway, out in shareholders, probably to buybacks, probably to dividends. So very questionable investing here, and it's a really bad idea, I think, to invest at a PE ratio of 35 into a business like this. You're likely to have very low returns. What you're going to get is basically returns equivalent to your starting earnings yield. Starting earnings yield on a PE of 35 is like 3%. Maybe you can expect 3% returns on your investment. That's not an attractive yield to expect over the long term. So for me, that's very unattractive. If you're enjoying this video so far, if you're learning something, hit that like button on this video. For those of you who've been here before, you gotta be hitting like on all my videos. Let the YouTube algorithm know that you're enjoying my content so others can find it. And if you want to see more of my content, you need to subscribe. Hit that subscribe button and ring the bell. By ringing the bell, you'll be notified as I upload new videos each and every week to my YouTube channel. And I don't always know which day it's going to hit. I'm trying to hit 3 to 5 days a week, but you need to be notified so that you can watch them as soon as they come out. Now, income statement. See what else we can learn here. You can see this big difference between the revenue and the cost of goods sold. That's showing that branding power. Again, signs of a quality business here. Very, very high gross margins. You can see the stability here of these gross margins. 58%, 58%, 60, 60, 59. Very stable gross margins on that income statement. You like to see that. Now, they have grown their SG&A, but they've kept it relatively intact, only growing it to $6.4 billion from $5.9 billion. That's managed quite well to do that over the course of a decade. So bravo to them on how they're managing that. You can see that they do have some debt here that they're paying some interest costs on, and that's likely to continue to grow depending upon how it's structured. Now, you can also see that I was right, that they have basically bought back shares over time, which is part of why this company is actually less profitable than it was before. So you had $2.4 billion in profit at the beginning of the decade, $2.16 billion at the end of the decade, but your EPS is flat. And that EPS is flat because you've bought back shares. So without the buybacks, EPS would have actually dropped across the decade. Very, very concerning there. Now, it's good at capital allocation, but they clearly lack the ability to reinvest in their business at the same returns of historical rates. So that is concerning. Now, first thing we're going to see here is look at PP&E. So you see here about $3.7 billion, $3.8 billion in PP&E, and that's relatively flat across the decade. That's good because it means you're not having to increase it as the business grows. But compared to your PP&E, you actually have grown your debt from $4.4 billion to $7.3 billion. So you've grown debt, and that's what I mean by it's basically being run with debt, not equity, because they've been able to grow the business more than the capital put into the business. And they've been able to just use debt to make that funding mechanism. So let's see if we can see shareholders' equity. You can see it basically dropped to nothing. It started the decade at $2.5 billion. It ends the decade at $1 billion. You get as low as $17 million at one point, and that's because they're able to cut this treasury stock number continues to drop as they pay those buyback shares higher than the book value, and you're just tanking the overall shareholders' equity in the business. There's nothing wrong with that. That's just an accounting trick. It doesn't mean anything bad, but it is showing the inherent quality of this business in here. So despite it being very quality, though, you're just not getting the returns you'd like to see. You do see some stock-based compensation here. This is actually really can be really harmful because you're having to buy back those shares at really high rates in order to prevent dilution. So you're issuing, 100 million shares, $100 million worth of shares in stock-based compensation. I don't really know why you're needing to do that, but you're paying, over $1 billion a year in buybacks. You pay a lot in dividends here. And what's interesting here is if you combine the buybacks and the dividends, it's more than your net income. So $1.3 billion plus $1.6 billion, you're basically having $3 billion in cash paid out when you only had $2.3 billion in income. You have $3.1 billion in cash paid out to shareholders, and you had less than $3 billion in net income. So they're paying out more than their net income each year to shareholders. That's not really sustainable in the long term, but they're able to do that because they're continuously growing the debt pile. So something to be aware of, you're just unlikely to get very high long-term returns with this business. Amazing quality, terrible price. So for me, it doesn't go on my watch list because it doesn't have the growth, and it's really hard to grow out of a PE like this. So even if the PE was 8, which I think is probably a fair value for this business, is something like a PE of 8, I still wouldn't be super interested because I still want to be in a growing business. So I love what they've done here. This is being managed well, but it's topped out. It can't grow anymore. They're probably in every store already. They've probably maxed out their market share. And so for me, I would avoid Colgate Palmolive despite it being one of the best quality companies I've reviewed. So for that, I would pass on Colgate Palmolive. If you enjoyed this video, hit that like button. Don't forget to subscribe, ring the bell, so you can get notified as I upload new videos each and every week. Now, here's a chance. If you like these videos, I'm doing every company in S&P 500. The playlist will be in the background here shortly, if not already. And don't forget that if you like looking at companies like this, if you like this tool I'm using, it is quickfs.net. I have a link in the show notes. It's the first link there. If you sign up using my affiliate link and eventually become a paid member, you can sign up for free, no risk to you. But if you eventually become a paid member, then I get a cut of your membership, and I would appreciate that using my link if you have found value from my content. Thank you for listening, and until next time, stop paying fees, start building wealth.